Good evening, ladies and gentlemen, and thank you for joining the India's Outlook session. This is brought to you by HSBC. The annual Outlook as webinar will focus on the equity trends for the coming year. And my name is Karun Muta. I head the investment insights at HSBC India. You know, the pandemic has challenged even the most successful businesses, despite of the crisis in the industry. We have been able to navigate through the challenges, tough market conditions, and position itself to accelerate the growth. Particularly India, as you see, has seen a lot of resilience. Rising Omicron cases globally, but and also high inflation and supply chain issues continue to remain the key risk. Investors are exploring long-term structural opportunities such as green investing, digitalization. So we have an expert panel today with us, namely Pranjul, Bhandari, and Tushar, Pradhan, as I introduced them, who are really going to get to us how the equity emerging trends are looking like. And I'll just take a moment to introduce the speakers to you. First, I have with me Ms. Pranjul Bhandari, Chief India Economist at HSBC Securities and Capital Markets, and she's responsible for developing firm's position on macroeconomics and public policy in India. Leading the firm's economic research franchisee from Mumbai, having completed resident fellowship at the IMF Washington DC and working with the India Ministry of Finance, she brings with her rich experience on this industry. We also have with us Tushar Pradhan, CIO, HSBC Asset Management India, and he is responsible for all investment activities and strategies across the asset classes, whether it is fixed income, equity, or multi-assets. Well, with over 25 years of experience and having worked in key investment roles in US before returning to India, he brings him with global perspective on asset management. A little housekeeping before we get started. Please type in your questions in the question Q&A box below, and I'll address them post the presentation is done, and we will also have time for Q&A at the end. I'll now hand it over to Ms. Pranjul Bhandari to take the presentation forward from here. Pranjul, over to you.
Yes, great, Karun. Thank you very much, and thank you everybody for joining. So, you know, in the next 20 odd minutes, I'll talk about the Indian economy, how it's doing. You know, in the last 2 years, it's gone through two different very disruptive waves. And as we speak, it's in the midst of a third pandemic wave. With all of that, after shouldering all of that, will the Indian economy be able to reach for the stars, or will it just be overwhelmed by scars? So, you know, let's hope to get some sort of, you know, data driven analysis on that. But let me first start with, you know, the Omicron virus that is which we are going through right now. On the 1st of January, we had about, you know, 20,000 cases per day, which is now about 250,000 cases per day, new cases per day. So obviously this has gone up really, really dramatically. it's likely that in the next 6 to 8 weeks, practically all macroeconomic variables in the economy will get impacted by this variant. In fact, our daily recovery tracker, some data that we get every single day, we sort of bring it all together. Our daily recovery tracker has already showed some fall in the level of activity. And this has been driven mostly by mobility. The fact that because of risk aversion, or because of all the local lockdowns that have been announced, of various sizes, mobility has come off a lot. And that is something that is really pulling down our recovery tracker. What does all of this mean for real GDP growth? Well, before this variant had come, if things had gone normal, we were expecting about a 6% GDP growth in the March quarter, which will now probably be about 4%. So, that's sort of the hit we think that will happen in the March quarter. But there's also something interesting going on here. The fact that, firms and businesses with every passing wave are learning to live better with the pandemic. And with every passing wave, we are seeing the economic cost to be just about 1/3 of the previous wave. So, when I say GDP growth could fall from 6% to 4% for the March quarter, it's actually 1/3 of the cost of the Delta variant wave that we had seen back in the June quarter last year. So we're getting better and better at handling this in some sense. So this is, about Omicron. Had to start with it because that's the topmost at this point. But if the South African case is to be considered, then hopefully in a 6 to 8 week period, we'll also get over the Omicron wave. And then what? And I think that's the more important part. Our sense is that about 2 quarters after the Omicron wave are going to be very strong quarters of GDP growth, led by pent-up services demand. Now, this is important to sort of spell out services demand, because the recovery we found last year after the Delta wave was mostly led by pent-up goods demand. This time, it's likely to be pent-up services demand because far more people are vaccinated. And, in a way, you can argue that the goods demand has actually run its course. There's something very strong and special about services-led growth. What happens in goods-led growth? You can import the good you're consuming. And if you import it, then the benefits of that doesn't trickle down because it was not produced in your economy. But in services, think education service, health service, going out to a restaurant, most of the inputs, most of the manufacturing, most of the preparation is done domestically. So the trickle down is stronger. In that sense, the 2 quarters after Omicron are likely to be strong recovery quarters because of this entire trickle down of services demand. And moreover, it's not just goods and services pent up demand. There is a third kind of pent up demand, and that is the pent up demand for housing. After being stuck in their houses for so many, there is a desire by a lot of people to actually improve their housing, and there has been a big demand for residential real estate. If that trickles into real estate construction, meaning more demand for material, for labor, that could have very strong trickle down effects to the rest of the economy. And more so, it could be beneficial for rural incomes, because a lot of the people who work in construction sites are actually commuting laborers from rural India. So that's another pent up demand, pent up demand for housing, for improving your housing conditions. So on the back of these, I think the next 2 quarters, June and September, will be very strong quarters. The problem is that pent up demand by definition runs its course. And at some point, it sort of comes to an end. And once that happens, then I think growth could begin to slow. And I think at that point, a lot of people would be looking for the next growth driver. And and on the back of that, we actually have GDP growth forecasts which are actually coming down. So in FY22, we have 9.2. In FY23, we are worried about the second half of the year when the pent-up demand is over, and we sort of get a growth lull, and our full year GDP growth forecast is 6.8%, which is a bit lower than what other people are expecting. Our worry is that this is also the period when some of the scars that the pandemic has left behind will start to become visible. And one of the most important scar is the scar of rising inequality. Now, what we found is that big businesses have become bigger, small businesses have become smaller. The informal sector has got hugely disrupted in this pandemic. Um, it is a problem in India because about 80% of our labor force is employed in the informal sector. So if there are huge disruptions there, then the purchasing power of these people, this 80% of labor force, can get hurt, and that can hurt future growth and demand prospects of the economy. I call it the economic cost of rising inequality. It's something that we also saw in demonetization period. When demonetization was announced, it was hailed as a big reform. For the first few months, the capital markets, the stock markets did very well. Growth didn't really fall as a lot of people had feared. Things looked really good. But the second, third, fourth year after demonetization, every single year GDP growth was a little lower than in the previous year. So the cost of rising inequality, the cost of the informal sector being disrupted is something that doesn't show up immediately, but it does fester and it shows up down the line. So my worry is the second half of FY23, which is the time when pent-up demand will be gone, is also the time when some of these scars of rising inequality could, start to show up. And this is what I worry about. But honestly speaking, is everything very sort of bleak from here? Not really. I think there are a lot of bright spots. There are a lot of positives still in the system which we need to be cognizant of. In particular, there are two new growth drivers that have come in the pandemic period. One is the huge buoyancy within tech startups, digital startups. In the last 5 years, they've attracted $80 billion of inflows. They are doing capex. They're inculcating a culture of entrepreneurship, which can be a secret source of long-term growth. There are a lot of positives in that sector. The only problem is that it's still a very small sector. It only employs about 1% of India's population. So still, India's workforce. So still a very small sector, though it's very vibrant. The other big sector that has come in India in the last 2-3 years is high skill exports. IT services have been rising, the exports of drugs, pharmaceutical products, some automobile parts, mobile handsets, some specific machinery. Some of these high-tech exports are doing well, and we are actually gaining market share in these. But the problem is that low-skill exports are not doing well. Things like textiles, agricultural exports, we're actually losing global market share there. And in a way, the two cross each other out. So some new sectors are there and there is some excitement, but they are still small and need to grow further. The other thing that we can look forward to are government reforms. And I think this is an important area because the government is sort of undertaking some important reforms. I'll call out three that I'm particularly watching. One is the fiscal reform of asset monetization, the fact that the government wants to sell a lot of the completed assets, like completed highways, airports, to the market and use that money to create new highways, new airports. So basically finding a way of churning the same pot of money and creating more and more new age assets. So that is one thing which the government is very serious about, and I think it will have growth benefits over time. The second is financial sector reforms, things like the insolvency and bankruptcy code, which, have been started long time ago, but are only improving gradually and becoming, more and more effective and efficient gradually. So that's an important one to watch. And the third one is manufacturing sector reforms. For instance, the PLI scheme, the production linked incentive scheme. It has been a success for mobile phones. My worry is that maybe the government is trying to do too much with it. It's trying to use it as an export promotion and an import substitution tool. And whenever the government uses the two together, it all becomes a bit muddled up and nothing comes out of it. Think about the 1970s. A sort of like a lost decade. My hope is that going forward, the government only thinks about it as an export promotion strategy and doesn't really start slapping a lot of import tariffs, something it has been doing in the last couple of years. So I think that's another reform to watch out for. If done properly, it can, have several positives. Our number one indicator for all of this is going to be the budget on the 1st of February. Last year's budget was a good, solid budget. It had all the right sort of principles in it. Transparency, a lot of past dues to FCI were paid off, credible numbers in terms of tax estimates and so on, high quality spend, focusing on capex, uh, gradual consolidation, which is also important. It had all the right sort of parts to it, and my hope is that they continue with that even this time. All of that, and also tax rate stability, not making too many changes in the tax regime. I think all of that will be very important to bring in a feeling of predictability and stability, which is very important for activity to flourish at a time when the global environment is extremely volatile. So I think the budget is going to give us a good indication. So putting all of what I've said, in numbers, um, our sense is that India's potential growth right before the pandemic was about 6%. When the pandemic is behind us, India's potential growth could fall to 5.5% on the back of the fact that there are scars of inequality which are going to show up. But if the government is able to do some of these important reforms properly and in a good time frame, then potential growth can rise back up to 6%, and hopefully even more. So that is the whole growth thinking. Moving on from growth, inflation, definitely a subject that needs to be spoken about because it's a global worry at this point. In India, inflation has been high and sticky through the pandemic period. Both headline and core inflation have been north of 5% for the last, 2.5 years. And going forward too, there are a lot of upside risks. Oil prices are on the rise. A lot of small firms are sitting on very depressed profit margins. Once they start raising prices and passing on high input prices to consumers, inflation could only rise. So there are a lot of worries on the inflation front. Our sense is that the RBI is going to embark on a monetary policy normalization path strongly this year in 2022, particularly once the Omicron wave is behind us. Two things. One is draining rupee liquidity. They already started that last year. In fact, we've already seen some of the interest rates rise across the yield curve, short end, long end. They have been on the rise. But this year in 2022, we also expect rate increases. In the first half, we are expecting reverse repo rate hikes to normalize the policy corridor. In the second half of 2022, we are expecting two repo rate hikes. So two repo rate hikes in the second half of 2022, and then two more repo rate hikes in 2023, taking the repo rate from 4% to 5% is what we are thinking. It's still very gradual. It's not aggressive, but it is definitely monetary policy normalization on the back of rising inflation. So that's on the monetary policy front. It's very important to talk about the trade deficit, because suddenly in September 2021, the trade deficit suddenly doubled, led by all kinds of imports, oil imports, gold imports, consumer goods imports, all kinds of imports rose, and the balance of payment moved from a positive to a negative for the first time in many quarters. And is this a worry? Well, look, it's definitely something we are going to track, but we're not really worried about it right now. We think the BOP moving into deficit actually gives some breathing space to the RBI. The RBI had a problem of plenty last 2 years. There were just so many dollars coming into India that the RBI was going on buying these dollars in sort of like a frenetic speed, and putting a lot of domestic liquidity in the market, and that was becoming inflationary. Now that BOP is getting into deficit, the RBI doesn't have to buy dollars. In fact, it needs to sell dollars. And when it sells dollars, it actually drains out that rupee liquidity from the market. And that in itself can become a way in which it sort of normalizes the excess liquidity that is there right now. So from our perspective, a BOP deficit for a couple of quarters is not really a big problem. Rather, it is a boon for an RBI, which is looking for different ways to drain out rupee liquidity. Finally, a word on fiscal. I would say, in a sense, it's been the brightest star in the macro landscape. Tax collections have been very strong, particularly corporate tax collection, GST tax collections. One of the reasons is rising formalization. Though, I worry that if it's formalization on the back of disrupting the informal sector, then, you pay a price for it later. But, let's talk about that in a different in a different seminar. For now, I think tax revenues have been a big positive. And in fact, it has afforded government some extra space for spending. So now the government can easily spend about 0.2% of GDP more to fight the Omicron wave if it wants to, and still meet its fiscal deficit target of 6.8% of GDP. So that has been a positive. The negative is that, things are looking good in a percent of GDP term. Next year's fiscal deficit can come down from 6.8 to 6.5, or even lower. In percent of GDP, fiscal is coming down, but the rupee terms, in rupee terms, the government is borrowing a lot from the market. In fact, we think in FY23, government borrowing, gross government borrowing of central government could be close to about 12.8 trillion rupees. That's a lot of paper that bond markets are having to absorb year after year. And I think there will be pressure on bond markets on the back of, the huge borrowing that the government is doing in rupee terms, although as a percent of GDP, fiscal deficit is coming off. So, I'm going to sort of come to a close now. Just to summarize, Omicron is likely to bring growth hiccup for the March quarter. After that, we are going to have 2 quarters of very strong growth, led by pent-up services demand, also pent-up housing demand. But pent-up by definition ends, and once it's run its course, around the second half of FY23, growth could begin to slow. At that point, all eyes will be on government for reforms, and the government will be in pressure to execute some of them quickly. Inflation has been elevated, and this is going to be the year 2022 when the RBI will have to move on hiking rates. The trade deficit has widened sharply, but in our view, it is providing some breathing space for the RBI right now, so we don't look at it very negatively. Fiscal finances are looking good, but there is a lot of bond market pressure, which the bond market will have to live with over the next year or so. I'll end with that. It's been a pleasure talking to you, and I'm happy to hand it over to Tushar Pradhan.
Thanks a lot, Pranjul. Always a pleasure to, be here in front of the best select clients that Hsbc has to share our views in terms of what all of this means for markets. Pranjul has taken us through the economic picture, inflation, the macro picture in terms of where India finds itself and what to expect going forward. I will take the next few minutes to take you through how that and what that means for markets. And it is something which is something of interest to all of us, because investments are always something which are interesting in the backdrop of the economy. So without further ado, we are titling this presentation, The Price of Success. And that's because we've already achieved a significant amount of success in the markets. And I will take you through what it means when we say success, what the success really means. So the subtitle basically is focus on growth, but eye on volatility, which means that, as Pranjul also mentioned, the potential for the Indian economy to grow very strongly from here is there. We are looking at some of the fast-moving economic data, which tells us that there's a lot of momentum within the economy, and the growth clearly is showing up in various ways. However, I think what the markets need to be worried about is bouts of volatility which are likely to come our way. It's not going to be smooth sailing. But what is most important is to understand that it has been smooth sailing for some time. So if I can request for the next slide to come up, it gives a picture of what it means when we say success. As you can see, it's a nice spoonful full of sugar. So you all know when you have a lot of sugar, that after the sugar high, there is a sugar low. And I think that is something we may experience this year. Going to the next slide, which is a little busy slide, but I'm going to take you through some of those data points vocally so that you don't have to peer your eyes onto what the slide is all about. it basically tells you what success for markets has meant in the year 2021. As you can see, this is asset class performance. And what we have done is put together mutual funds which represent that asset class and taken an average of the returns which investors have got across a range of these funds which are available in the market, which also explain where these asset classes have yielded. The best performing asset class last year was small cap. It delivered returns upwards of 59% on average across all funds, followed by mid cap at about 41%. Now we are talking about very significant returns here. We're talking about very solid double-digit returns. And if you start going a little further down the scale, then you have your large and mid caps, value, thematic, so far and so forth, going into the average about 30% returns for one single year. So these are successes in the stock markets. If I take you through to the middle portion of that asset class returns slide, then there is a corporate bond fund category which has yielded you 9%. There are low duration bond funds which have given returns of, for an average, about 10%. Ultra short duration and short durations range between 5 to 4%. And then towards the very end of the spectrum, on the last end, you have liquid funds at 3% on an average. Gilt funds, surprisingly, are really, really low at around 3%. And ETFs, gold, actually negative returns. So as you can see that you had a host of these kind of returns given over this last year. And when you compare that with a 5-year average is where we really need to be careful about. So the 2021 return is denoted by the red bar, but the black line which goes across the red bars is the 5-year compounded average growth rate of the returns delivered by that asset class. So as you can see on the left-hand side, it crosses almost halfway through the red bar. And as you move to the other end, the red bar actually is lower than the 5-year average of the asset classes. So what it actually tells you is that while this 2021 has been a successful period for some asset classes, it does not really reflect the average 5-year return for those asset classes. And I think there has been a little bit of a shift in terms of how we view these asset classes going forward, because if you've had very significantly above average returns for any asset class, one should brace for the fact that over the next period, the averages, as we call them, will even out. And obviously, you will not make that kind of return that you may have got this year. So essentially, what we're saying is that post the recovery from COVID and through the lockdowns that we've seen for the last year, equities have performed extremely well. Even fixed income to a certain extent, if you take corporates or corporate bond or credit risk, they have given you a significantly decent return, close to maybe a 5-year average. But once you move into quality and shorter duration, those returns have been much lower than a 5-year average that we've seen in the past. And I think that is something to do with what Pranjul spoke about, is this adequate liquidity which has been supplied in the market. So the near-term liquidity has pushed near-term yields much lower. And as a result of which, the very, very near-term products have not given you that kind of return. They get repriced. And it is very surprising that for a country like India, which is famous for inflation, near-term rates continue to remain very, very low throughout this period. So I think that's been the cause for, these kinds of returns that we've seen in the last year. How will these returns look like in the next year? I think that's something that we can debate later on. But the fact is that clearly this picture is unlikely to be repeated. Now let's look at success elsewhere that we've seen in the last year. Let's look at the next slide. Success in macro, I think I won't spend too much time here because Pranjul has already covered the basic elements of what we mean by success in macro. The Indian economy has bounced back from the COVID scare that we had at the start of the year, which is February and March, where suddenly there was a very, very large COVID wave. The Delta variant really played havoc with most of our cities, especially Delhi, and the metros as well. But we did recover from there. And as you can see, after the February-March dip, significant drop, say, for example, the leftmost chart talks about the Indian PMI, and that activity was so sharply down throughout that period. But then after that, over the rest of the year, the PMI smartly has moved up very significantly. Even if you take the employment trend, the impact of the lockdown started to get felt probably by the middle of the year. So from January to April 2020, you can see that is really where the first lockdowns really had a big impact. But if you see a YOY impact, there was a pretty significant uptick in employment once we moved out of the lockdown. And that's the success in macro that we're talking about. Of course, the base effect starts to make its impact again in October of that last year, as you can see, the base impact bringing the employment number down again. But nothing really dramatic to say that we are negative, compared to where we were some time back. I think it's kind of recovered. And I think the reason behind that has been exceptional policy support, whether it is from the fiscal side, whether it is from the monetary side. I think the authorities have really done well to kind of soften the impact of the lockdowns that the Indian economy had to take. And finally, the India industrial production picture is again showing you a tremendous base effect in the middle of last year, as we saw, compared to the very sharp drop that similar periods in the year prior had been the cause for a very sharp drop in industrial production. So essentially, I think what this is talking about is that there is reason to believe that the macro picture has bounced back after the impact of the lockdowns that we took last year. Next slide will show you a little bit of the success that we've seen in corporate fundamentals. So when we talk about success here, we are talking about the earnings trend. We are talking about corporate margins, and we are talking about the ROE for Indian economy, for the Indian companies on an average. So we have struggled with lower ROEs in the last decade. We've seen, corporate ROE significantly go down for various reasons. Either where Pranjul mentioned about the slowness of the Indian economy, the various impacts of the demon and the impact it has had on the overall economy, so on and so forth, the inequalities, for example. But what has turned around in the last few years, in fact, going back into 19 and then onwards, is there has been a tremendous improvement in corporate fundamentals, including the ROE picture as we see. So we are actually back to what we call as an average ROE for India, what we saw in the last decade, when there was tremendous growth, and we talked about 8.5% GDP growth rates in the last decade. I think that is slightly coming through, at least in the ROE picture as we see in the last few years, last couple of years, I must say. And that has something to do with corporate margins and profitability in general. And that's a little counterintuitive, given the fact that we have had a very large lockdown and this COVID situation hanging over our heads. But what has happened is that corporate India has actually done very well throughout this period. And it could be for various reasons. As Pranjul mentioned again, that the informal economy that India used to run on could not capture in full the overall corporate profitability, because obviously a lot of these volumes were moving into the unorganized sector. But because the unorganized sector has encountered some really serious damage in terms of its ability to operate, a lot of that demand has shifted to organized corporate India. And that is the simplest example one can give is in FMCG. So for example, there is obviously a basic demand for food, right? So consumable food items, which normally any household across India will need as a sustenance. Now, in the past, a lot of these informal arrangements for this food distribution used to be taking away a lot of market share from, say, biscuits or snack items that a formal listed company may be offering. Now, because the informal economy was not available to supply that sort of demand with anything meaningful, because they shut down, they all moved back home or whatever, all of that pent-up demand started to move towards organized FMCG products. And we are seeing a significant improvement in overall volumes. And typically what tends to happen is, even with the advent of e-commerce, we are seeing that a lot of this demand from rural India, from middle India, has now shifted to e-commerce, which is showing up in the margins for corporate India going forward. So I think there has been a shift, and this shift is quite a significant one and a permanent one. And I think what we see here is a function of that success that corporate India has seen. Corporate margins also are a function of reported profits. As you know, that India has undergone a significant tax reform where corporate taxation rates have been brought down so substantially that whenever there is an upswing in revenues, as we've seen now on the back of that bounce back, it starts to hit your bottom line automatically. So any incremental or marginal improvement in revenues straight through hits your earnings per share because your taxation levels are significantly lower than ever before. So I think the margins that we talk about and the sustained profitability and the prospect of corporate India continuing to sustain this level of corporate profitability is pretty high, according to us. So I think that's another success that we can talk about, which has happened in the last year. If you look at the next slide, it gives you a little bit of a success story that we have had in the political economy. And again, I'm treading a little bit on Pranjul's field here, but she did mention that the Omicron impact is likely to be pretty strong. But if you look at the success that India has had in vaccinating its population, and I think I compare this with the rest of the world, including some of the most developed economies, where the governments have struggled to induce people to get vaccinated. In that backdrop, the sheer number of people that India has and our ability to have vaccinated a very significant portion of that, at least one vaccine, has been a tremendous success. And I think the reason why the Omicron wave can remain mild and it may not dramatically alter the picture is because of the sheer number of people who have actually got vaccinated. And as a result of which, the impact on hospitalizations, on deaths, on serious illnesses caused by COVID has been a very, very significant success for us. And I think that's something which cannot be ignored. And I think the rapid rate of vaccination in India, at least the first jab, has been a political success for the economy. We also feel that the policy uncertainty in which India used to rule in the last decade, that has shown significant improvement in the last few years. So this index of political uncertainty is at a decadal low. There is a lot of stability in terms of, or an expectation in terms of where policy moves, as opposed to in the past where it was, driven by different concerns and it would lead to almost contradictory policy moves on a yearly basis. I think we've moved a lot away from that sort of regime. And I think that's also lending a lot of support for India as a country. And again, the other success we can talk about in the political economy has been the strong GST collection. And I think it's linked to what I talked about in terms of the formalization of the economy and the move away from the informal into the formal, which leads to significantly higher rates of GST collections. My significant contribution here in terms of thought is that I feel that this is just the scratching of the surface. I still believe that there is a significant amount of, I would say, non-formal activity which happens in India, which still is not capturing the potential for GST collection in the next 10 years. So when we look at markets and we say, well, what is the potential for India as an economy? What is the potential of corporate fundamentals? I think if you expand your vision from saying what's likely to happen next year to saying what is likely to happen in the next 5 to 10 years, I think I have tremendous confidence in what those GST collections will look like 7, 8, 10 years from now. As the economy formalizes, as everything, all of these systems start to work together, I think there is tremendous potential for our economy to manage revenues at a scale which is significantly higher than what we are talking about at this time. So I think this is the other success that we can talk about in the political economy. I'll take some few minutes again for the next slide to share what I mean by the price of the success. So if we can go to the next slide. Obviously, all of that success, all of that sugar that we've eaten cannot continue. The party has to end somewhere, or we have to be worried about how much sugar we imbibe. So what we are talking about now is that because of the good elements that we have seen so far, we are likely to see some challenges in the next year. The challenges, as I have mentioned in this slide, go with a host of situations, starting from price pressures. As we know that inflation has been rearing its head across the economy, whether it is commodities, whether it is services, whether it is simply just going to the anecdotally going to a movie theater, which I did 2 months ago. The 50% capacity has yielded double price for the cinema ticket. So something that you could afford for like a $250 was easily 600 rupees per seat. If you go on to the cafeteria, the $300 popcorn was now, yes, $450, right? So I think the kind of inflation that we're seeing, and people are willing to pay that. I was willing to pay that. I was going with my children and said, fine, we've not been to a movie for 2 years. Why don't we do this? That is being reflected in services. If you go take a haircut, say, for example, if you go and take any of these services, they are all significantly overpriced because of the impact of the lockdown that they had to face. So I think these price pressures are not going to go away right away, which means we will face these pressures going into this year. It will either phase out over the base effect in the year after, or there may be even some tempering after the demand starts to catch up and the capacity then and the supply disruptions also start to ease out. So while inflation is a problem for now, I still feel that it is not really a very significant structural move, that we are moving into a significantly higher inflation regime, both globally as well as in India. So I think these price pressures are temporary to a certain extent, and that's our base case. There are world spillovers, as you know, that the Chinese economies has slowed significantly because they have taken a very acute view of zero tolerance to COVID, and that has led to very significant changes in the way they travel, they allow people in their economy and out, and so on and so forth. I think that will have an impact. And in addition to that, of course, they've had a significant challenge on the real estate sector, and generally their economy has been a little bit under a cloud, including their equity markets. So I think those spillovers will somehow start hitting the rest of the world trade at some time. The other, I would say, price of this success, price of this very high returns that we've seen in some of the equity classes as well as some hybrid classes, leads to lower future returns. So whenever valuations come up to significantly higher long-term averages and above, future returns look slightly constrained and challenged. And I think that's the price of success that we have to pay even in markets. We are talking about a transition economy. We're talking about capital in the world now chasing responsible businesses, sustainable businesses. And that is a transition that we are talking about globally. Now, what does that mean for India? What does that mean for the emerging markets? I think that's a price that we have to pay, that some of these businesses which will end up not being sustainable either because they use fossil fuels or the fact that they are polluting may not attract that level of capital. And Pranjul spoke about the technology business in India, which is attracting a lot of capital simply for the fact that it represents this entrepreneurial streak that the Indians are showing at this time. And it is away from the smokestack, large manufacturing kind of setup, which may be required actually as India goes forward to grow and takes its place in the world. But I think for now, I think that is a transition that the world economy is going through, and we may face some sort of impact and the price of the success in the coming years. So I think that's a little bit what I wanted to share with you in terms of our themes and our outlooks. We still feel that equities as an asset class is a preferred asset class simply for the fact that we will continue to see buoyancy in corporate fundamentals. We will continue to see earnings growth rates continue to sustain throughout the next financial year and the year after. We see sustained earnings growth coming through margin improvements and the sheer buoyancy of the economy, which is going to drive these economic fundamentals going forward. However, the kind of returns that we've seen in the last 1 year or even the last 2 years, we have to temper our expectation in terms of what kind of returns we get. We're not going to get those returns, but clearly as a preferred asset class, we do believe that equities will do well. Fixed income is a question mark. As I said, there is a very steep yield curve that we took last year where the near-term rates were very low and the longer-term rates had a 300 to 350 basis point differential. So there's a very steep yield curve that we're talking of. The shape of the yield curve, how it moves and where the liquidity moves will determine what sort of debt products will make money next year. But overall, if you feel that interest rates are likely to inch up gradually, which they already have a little bit, then it's going to be very challenging, especially at the long end, to kind of make some significant returns out of those asset classes. However, having said that, each of these asset classes have a place in an asset allocation function, which means that you cannot ignore them. Even if they're not going to make you money, they will provide you the stability of capital preservation in case there is volatility on some of the risk assets as well. So they do form part of a plan, and we would encourage you to interact with your RMs and people who are planning for your financials to understand that while it's going to be a volatile world, each of the asset classes will find some place in your asset allocation to ensure that you plan for capital preservation in a time where we think volatility is likely to reoccur in this year financially, especially in the market. So I think that's the overall view on the asset classes that we look at. I think, as I said, ESG as well as the transition economy is opportunities that one should keep looking at. Even if they're not available in India, if there are opportunities for investors to look at these opportunities through various products outside of India, I think that's where the multi-year kind of opportunity does exist in either sustainable finance or ESG or whatever we want to call that. And I think that is how investors should broaden their investment allocation, look beyond the more traditional asset classes and see where that takes them. With that, I will come to the end of my formal presentation. Thanks again very much to HSBC for inviting me here, and very happy to interact later on a Q&A basis. Thanks.
Sure. Thanks, Tushar. I think that was really wonderful. And thanks, Pranjul, as well. I think you started with a very good perspective on the macroeconomic front and led by Tushar, who gave his view on the various asset classes. I think let's begin the Q&A session now. We have a lot of questions actually coming up, and I'm really overwhelmed the number of questions that have been put up. But let me selectively put some of them, which will really take care of a lot of perspective that we have already shared with us. So let me start with you, Pranjul. You did mention about a gradual recovery after a hugely disruptive second pandemic wave, and which is more likely due to the pent-up demand. And GDP is likely to reach the pre-pandemic level later. Implying that there will be no growth since early 2020. What will it take to reach the early pre-pandemic levels, that is 6% plus growth that is kind of in the visibility after the next 2 quarters that you did mention that anyway that will be going strong?
Right. So, look, to be honest, even in September of 2021, we had actually gone back to pre-pandemic GDP levels. We had already gotten there. If you look at the GDP data, the September 2021 quarter data that we have already got, we were back at pre-pandemic levels. But there's a difference between pre-pandemic level and pre-pandemic path. Just by saying that I got back to the level where I was 2 years ago, is nothing to sort of cheer about in an economy, which has so much of growth in front of it. The pre-pandemic path was a path which was giving us 6% GDP growth every single year. And if you sort of see where we are vis-a-vis, where we would have been if we did not have, the pandemic hit us, then we are still about 8 to 10% below the pre-pandemic path. So we've got back to pre-pandemic levels, but we are about 8 to 10% below pre-pandemic path. Now, what will take us back to the pre-pandemic path is basically the same question as what is going to assure us a potential GDP growth of 6% or more over the medium term. And my sense is that at this point of time, it's government reforms. I think we've sort of come to a place where we've basically are going to get everything we can out of pent up goods demand, pent up services demand, pent up housing demand. But once all of them are gone, then what drives growth after that? The best driver of growth, the most sustainable driver of growth, generally tends to be investment, capex, private sector capex, because that is your long term source of growing jobs. That's your purest form of growth you can get. But today, the problem is that while corporates' balance sheets are in a much better place, they've deleveraged, there's a lot of cash out there, liquidity is there, rates are low, but there's still a lot of policy uncertainty in the picture, especially if you ask an investor, where do you think growth will be 2 years down the line? Somebody who actually puts money on the ground, it's very difficult for them to get a sense right now because there's so much of volatility in the system, both domestic and global. So my sense is that until the volatility is not taken care of, we won't get to see a proper investment cycle. And for the volatility to get taken care of, I think public policy will have to become a source of stability via reforms.
Sure. Thanks, Pranjul. Let me take it to the next level. Tushar, I think you did mention about the growth that India is going to witness, and India being the sixth largest economy in the world is really characterized by an exponential consumer base, rising young population, with technology skills sets and liberalized government policies that Pranjul did mention that is going to shape that's going to shape up the economy of future. But are these some only lucrative factors that may attract investments in India, or the government needs to do more about it?
Clearly, I think there is always more to be done. But I think we tend to rely more on policy to decide whether it will attract capital or not. I think what we've seen in the past few years is that in spite of policy or in spite of difficulties in policy structures, India has managed to attract a lot of capital, whether it's through the FPI route or it's through the FDI route, simply for the fact that there is a change in the thinking in the world in terms of how supply chains are going to be built. And I think people have realized the danger of concentration of supply chains. And there is a move away to make sure that supply chains work in all kind of conditions. Especially the pandemic has brought forward a very, very significant challenge for all supply chains all over the world. So I think it's a lot of these combinations of factors where we feel that there is going to be a significant demand for setting up of and Pranjul also mentioned the PLI, which may have right intent, but at some point of time it is going to generate capacity. Whether you talk about ICs, whether you talk about integrated circuits, whether you talk about any of these initiatives on the electronic side, which will lead to significant manufacturing and supply chains. So I think policy is something which we get worried about. But I think there are individual opportunities which go beyond policy. The sheer demand for such requirements, fed by, of course, the fact that India has a very significantly important demographic cut. We have a large mass of people who are skilled in that sense, though the economists might argue that it's not very inclusive. But the fact is, it's a very large pool of people, which is not available to that extent anywhere else in the world. And you can talk about the Southeast Asian countries, you can talk about the South American countries, you can talk about East Europe. None of these other economies provide a common market of a pool of talent which is available in India. So I must admit that I'm a little more optimistic. about the Indian situation going forward. And I think capital moves like water, right? So if you create a little bit of a vacuum somewhere, it will get attracted towards that. If you enable the movement of that water to flow, then it is possible to get through. But if you create barriers, then obviously water sloshes in one area and does not move together. So that's really generally how I look at the stuff overall. I think India can continue to attract capital, and it is not necessary, as has been displayed in the past, that it's only policy that helps this availability of capital.
Absolutely, Tushar. Thank you for that. And coming back to Pranjul, a key feature for the government policy is that it needs to be stable and predictable. And you did talk about the strong budget last year, which promised gradual fiscal consolidation with fiscal transparency and high quality of spending. Of course, with the pandemic, it went off slightly off the track. What would it take to deliver on each of the above?
On the budget promises?
Yes, yes.
Actually, to be very honest, I think a lot has been delivered on the budget promises made last year. In fact, when I was making my presentation, I said that that's probably the brightest star in the macroeconomic landscape. The fact that they're likely to stick to last year's fiscal deficit, in fact, do better. They're likely to consolidate by about 50 to 60 basis points as they had promised. Capex spending by central government, is up 13-14%. They had sort of, aimed for higher capex, government capex. They've been able to do that. They were able to pay FCI dues. That is very good for transparency. So I think they made well thought out promises which they knew they could do, and they focused on delivering on that. And this, I must say, was very different from many budgets we've seen in the past, which used to make ludicrous promises on consolidation or tax revenues. And, the minute it was announced, it was discounted. And then they never sort of, they were never able to deliver on that. So I must say that the budget has been a source of stability, particularly last year, and I'm hoping that the same record is also followed in the next year. I think that's the best the budget can do at this point. A lot of people ask, what should they do? What more should they announce? What more tax policy changes they should make? I think the best they can do is be boring, not make any changes. Don't make any tax changes, because what business likes is tax predictability, tax stability, not shocks year after year. Should they add new schemes? No, they should not. They have enough schemes. They should just make sure that they fund them properly. For social welfare, they have Narega, they have central government capex, they have money they have to give to the states through a couple of routes. Just stick on all of these pipelines that you have announced, and all these institutional frameworks that are already there, rather than doing anything more. And I think that in itself, for me, will be a budget which gets 5 stars.
Sure. Tushar, as Pranjul did mention about the government pursuing some policies regarding important fiscal policies, reforms like asset monetization, creation of the bad bank, and the incentives for the manufacturing. Did she did mention about the production linked incentive as well? How do you see its roadmap towards execution and implementation?
I think we already are seeing the benefit of significantly higher ordering in some of the balance sheets that we looked at, especially on capital expenditure. So it's already starting to show up somehow, and especially the larger engineering companies also are displaying significant optimism in terms of how this goes forward. So clearly, I think I'll be in Pranjul's camp to say that, look, you've started the process. Now let the process actually build itself out. Let the people who are involved in the execution come forward and actually do whatever they need to do, rather than continuing to push them in some direction. You have enabled them the environment to ensure that they take that up. And I think the key is interest rates. One of the biggest catalysts for India always in the future has to be lower interest rates. Because essentially India is a capital scarce economy, and whenever capital becomes expensive, and the case in point to look for is that in December we saw the credit deposit ratio shoot up significantly, And if it leads to any sort of shortage of capital available for the growth that we are estimating, is going to create a little problem for the entire growth story going forward. So how the availability of capital, how the rates at which this capital is available to a large swath of Indian corporates continues to remain my biggest concern, and the key to ensure that that is the promise is delivered. Because very soon, if we change policy to make it more restrictive, take the liquidity out of the system, just when the demand starts to pick up, is absolutely going to be the wrong time to do that. So I think policymakers need to see this through, to say that yes, we will live with a little bit of inflation. We will allow liquidity to remain strong, because that is going to feed the growth going forward. So these are the challenges I think we face going forward.
Absolutely rightly said. I think, Tushar, I will take that cue from the policy makers that should really retain the rates at this particular level, and probably want to check with Pranjul. The one thing that everyone is fearing from the global facts is the US tapering and probably the hike in rates. We have in India domestically already faced some higher inflation, and we continue to face it probably because of the reasons that you did mention, how it is going to shape up. How does it really impact, particularly the global tapering and the yield curve of the US, the Indian markets on the rate side? Have any sense how does it really will impact our lives?
Well, look, yes. So, to the extent global central banks are going to be tightening monetary policy, India is going to just import that tightening from the rest of the world, and we're already seeing that in some of the interest rates that we track, in some of the bond market indices that we track. So that's going to be one pressure that we face. The second is also the fact that we have a very large borrowing calendar by our central government and our state government. That's also something that is overwhelming the bond market. That's a second problem. So generally speaking, there are going to be pressures of imported financial sector tightening, and also our own very large borrowing needs. That is going to be a part of our at least our bond markets. But in terms of overall and sort of wider macroeconomic impact of Fed tightening, well, look, one could be an impact on the BOP. The fact that currently our trade balance has moved into a large deficit. If on top of that we see outflows from our country as the US starts tightening, then that could lead to a very big BOP deficit. We've already seen signs of some deficit in the December quarter. It's likely to continue into March quarter. So that's an area to track that generally happens when the Fed goes into a tightening cycle. But as I had mentioned, if it's going to be for a quarter or two, then I think it's not really a big problem for us, for the simple reason that it actually gives the RBI some breathing space. And another reason why it may not be a huge problem is because our FX reserves are now extremely high. They are more than double of where they were in 2013, when we had faced the taper tantrums of the Fed at that point. So from a very macro perspective, I think we are in a good place to withstand that shock. But having that said, that we will get impacted. Our bond markets will get impacted. Our currency will get impacted. To the extent most emerging markets will get impacted.
Sure, sure. Tushar, let this be the last question to you, because we are just running out of time. But I will really not leave you without knowing on the markets. And I was really excited when you presented the first slide, and I would really like to know which is the first bar going to be for this year.
Well, I'm sure we would love to know what the likely returns are likely to be, but I will maintain it, on more of a relative scale, that equities will be the preferred asset class across. The absolute measure of that return, one can never say, but I think relatively they will be better off for the reasons that we spoke about: corporate fundamentals being good, robust earning growth, and multi-year sort of growth period ahead of corporates going forward. So that will keep it pretty much there. Fixed income, if we do face this imported expansion in interest rates, then longer bond funds are unlikely to do well. However, I must say that overall worry about interest rates, damaging our economy, if the growth rate continues to outstrip the cost of capital, then that rise in interest rates is not likely to damage the overall asset picture. So I think that is something that people need to take heart in. And when this interest rate picture changes and if liquidity starts to become an issue, the near-term rates tend to go up. And as a result of which, some of this capital gets allocated to nearer-term bond funds as well, or intermediate or even short-term bond products, which basically give you that upside in terms of positive returns for the year. So I think it's a portfolio approach. One has to look at where all one can allocate. I think this year is more to do with capital preservation rather than trying to hit the stars to say where is my next best bar going to come from. I think a diversified allocation across asset classes will be the most beneficial.
Sure. Great. Thank you, Pranjul, and thank you, Tushar, for that wonderful presentation, wonderful takeaway. Quite happy that the real returns is the key, whether there is inflation, but if there is a growth accompanying the inflation, I think that is a very valid state to be in. Thank you so much, both of you, and we look forward for having more of such sessions with you. This concludes our session for the day.